As a financial advisor, we have a responsibility to take care of our clients, and you take care of them by educating them on the benefits of how to manage risk and how to construct a portfolio properly. And what used to work, managing portfolios, just having US stocks, US bonds, having some international exposure, doesn't work anymore because the correlations, meaning that everything seems to go up and down together in the equity markets and the same thing in the bond market. So as advisors, even if a client isn't comfortable, it's our job to educate them, teach them about the benefits of including this in a portfolio, because ultimately, when things are going up, everyone's happy. But the moment the economic condition changes, everything goes down, then they start saying, why didn't I have something to protect me?
I think that's a big challenge for we as advisors, is communicating this concept of alternatives. You know, what's it mean to go short a security and actually make money in a down market? Or what does it mean to capture volatility that's becoming a new asset class? There's a lot of education behind that so that an investor is comfortable taking on those positions.
We're dealing with a clientele that for the most of their investment lives have been long only. This is a relatively new asset class for them, and we want to teach them as much as we possibly can and let them understand how this particular asset class works for the purpose of mitigating the risk and lowering the beta and lowering the volatility while still being able to play the game. Of course, the game being the long-only stock market.
Long-only, more traditional asset classes tend to behave better in more trending markets as we know them. The alternative strategies that can be employed can benefit in other types of market environments also. And that's the benefit of, one, introducing new sources of return opportunities, as well as diversification and risk moderating aspects of portfolio construction.
I think the places we're seeing the most demand really comes from the sensitivities that the clients have. And those two sensitivities are volatility in the equity market and what they're doing about low interest rates just in general across the economy. So the two places we're seeing the most alternative demand tends to be in hedged equity because of the volatility, the amount of headline risk that's out there, and also in absolute return fixed income, things that have some yield, have some return potential, but don't necessarily have the interest rate sensitivity or the credit sensitivity that sort of traditional fixed income might have.
That's a fascinating question. Where's the money coming from? Some advisors are using alternatives as a complement to a traditional 60-40 balanced portfolio. So they might take equally from the equity and fixed income side of the portfolio to build their alternative selection. Others are taking it from the equity side of the portfolio, which contributes a lot to portfolio volatility, so they'll take a piece of that for a lower volatility portion of the equity side of the portfolio. Some advisors will look at the fixed income world. They might be concerned about low interest rates, the potential down the line for inflation, and they will look for fixed income complements to add to that. And the other category advisors look to are alternative strategies that behave very differently from traditional strategies, and those become diversifiers. So we see advisors taking alternatives from three possible buckets or across the board in a balanced portfolio.
If we can substitute some of that duration risk and interest rate risk out and get something on the order of another 5 to 6% in a long-short kind of liquid alternative product, from a long-short fixed income manager, a global macro manager, a merger arb manager, I would be happy with that. If we can get a yield of 4 to 6% without taking on too much equity risk or too much duration risk, I'd be pretty happy with that. So kind of bifurcating that portfolio into those two segments and looking to get something that is risk controlled, risk dampened, risk managed, maybe deliver risk around 4 or 5% kind of max. And if we can get some yields up in the 4 to 6% range, then that's going to be a pretty good outcome.
Definitely going forward, every portfolio will have alternative strategy diversification. We will get to a point where basically portfolio will be built top down, first by strategy diversification, and then we're going to sort out the assets. And that's probably something that's here to stay, and it's a fundamental paradigm shift.